There are two major categories of loans, and these can be institutional, private, or otherwise, or a hybrid thereof. Two major categories of loans are going to be portfolio loans and loans that are serviced by a third party. A portfolio loan would typically be something like that which is serviced by a small local bank or a loan that was given by a private individual. Oftentimes, hard money lenders, with the exception of major hard money lenders such as Kiavi, which are institutional lenders and borrow from the Federal Reserve directly, much like a major federally chartered bank would, that's a completely different nature, right? Because now you're dealing with an institution that has a whole bunch of rules and bylaws and all kinds of other shit it has to follow. When you've got a small local credit union that has exactly 3 branches and their entire list of rules, regulations, and guidelines would fit on a napkin pretty casually, that's an entirely different story, right? When it's a loan from a construction company, let's say a builder built the house and then sold it to a homeowner with X amount of dollars for a down payment and whatever the remainder was as a mortgage. They might service that themselves and they send out a bill every single month and they collect a check in their personal name or in their company name or whatever, but they don't even have a website where you can go pay it online. They don't have a 1-800 number that you can call at 3 a.m. and pay it while you're, in the middle of traveling with your kids to the soccer game on the other side of the country. So it's going to vary. In the case of most, to answer your question in the most useful way that I possibly can, or the most useful way I can attempt to anyway, most loans that we're going to deal with where there's going to be defaults are going to fall either into the Fannie Mae, Freddie Mac, which would be conventional space, or they're going to be FHA, VA, USDA, or some other form of HUD product. Okay.